You're watching today's market comment by Mario Hadjikyriacos. I'm Christina Marujos, and thank you for joining us here at XM.com. A paradigm shift has taken place in global markets this month after a string of disappointing data releases from the major economies eliminated any surviving bets of further rate increases and instead fueled speculation about a series of rate cuts next year. Market pricing currently suggests the US and Europe will launch a coordinated easing cycle in the spring or early summer of 2024. This repricing has helped push bond yields down, which has been a blessing for assets such as gold and equities that benefit from lower rates. In the FX arena, falling yields have translated into a weaker US dollar. But the key question for euro-dollar traders is whether current market pricing that sees the Fed and European central banks cutting rates almost simultaneously and by equal amounts next year is realistic, considering that the US economy appears much healthier than the Eurozone's at this stage. The latest edition of Business Surveys on Thursday will be crucial in shaping this narrative. The Japanese yen has come back to life and is trading higher for a third straight session on Monday after almost touching a three-decade low last week. Whether this is the beginning of a trend reversal or just another false dawn is questionable, but it does appear that the macroeconomic landscape next year favors the yen in an environment where foreign economies slash rates while the Bank of Japan raises them. Over in the United Kingdom, politics is back in the spotlight ahead of the autumn statement on Wednesday, where the government has entertained the idea of cutting income taxes as a means to boost stagnant economic growth. Any announcement of tax cuts might prove beneficial for sterling, both from a growth perspective and the interest rate channel. Lower income taxes would help shield the economy from a dreaded recession and also pour gasoline on the inflationary fire, which in turn could force the Bank of England to keep rates elevated for longer. In the commodity complex, oil prices staged a turnaround last week after OPEC Plus officials floated the idea of extending their production cuts into next year. It seems Saudi Arabia is concerned about demand weakness in 2024 and is trying to establish a floor under oil prices by keeping supply constrained. Gold prices enjoyed a sharp rebound last week, drawing fuel from bets that central banks will cut rates faster and deeper next year. The softness in the US dollar also helped the dollar-denominated precious metal to shine, with gold currently trading less than 5% from its record highs. Thank you for watching today's market comment here at XM.com. Have a great week.